In this video, we'll look at how to combine ETFs with single stocks. I'm Ramin, a financial YouTuber from the PensionCraft channel, and today I'm working with Trading 212 to teach you more about investing. Remember, as always, that nothing in this video constitutes financial advice, and you should always do your own research. So let's begin with what we mean by an exchange-traded fund. Essentially, these are funds which allow you to buy exposure to an entire market. These might be global stocks, it might be a single sector like tech, it could be a single region like Europe, or it could be a single country like the United States. And these funds can be diversified across hundreds or even thousands of stocks to remove what's called idiosyncratic risk. And that's the risk associated with the fortunes of a single company. You can also earn the upward drift in stock prices over the long term with ETFs. This is called the equity risk premium. So one way to think about these funds is that they define the broad outline of your portfolio. Let's contrast that with the benefits of owning single stocks. While ETFs provide broad exposure to a range of stocks, single stocks provide you precise exposure to a single company. And if we choose that stock correctly, that provides the potential for greater return than global equity exposure. However, a concentrated single stock portfolio with just a handful of stocks in it has a greater risk because it's not diversified. For example, you might have really high conviction that a single stock will corner its market and generate huge performance. If, for example, you'd have chosen Nvidia at the start of 2020, it rose over 700% over the next 4 years. However, conviction can also lead to large losses. For example, what if you'd chosen another very promising company in 2020, say Illumina? Its share price has fallen over 60% during the same period. Conviction is all very well, but you might want to diversify your portfolio just in case you're wrong. But what if we combine ETFs and single stocks? An analogy might be useful at this point. Here's a sketch created by the artist Holbein in the 16th century. This gives you a good idea of what the subject looks like in the same way that an ETF gives you a broad outline of a market. However, if we look at the final painting, there's a great deal more detail. What if we want a portfolio that's like the finished painting rather than the sketch? By combining ETFs and single stocks, we can get the best of both worlds. Broad and diversified exposure to global markets, and at the same time the potential to outperform those markets if you choose those stocks correctly. But even if your stock picks don't work out, you'll still earn that equity risk premium that gradually increases the value of your portfolio over time. Single stocks offer another benefit, which is to learn about investing. For example, lots of people like Tesla stock, but could you look at a financial statement from Tesla and gauge which indicators are going to affect its stock price? Perhaps you could go even further and produce a discounted cash flow model that'll tell you the fair price of Tesla. All of this is worthwhile because even index investors benefit from a deeper understanding of pricing and valuation, and the greater insight that that gives into how markets work. Finally, how can we gauge the amount of our investments to put into single stocks and funds? If you can buy global equity exposure with a single fund, then how much should you put into single stocks in order to try and beat that global market? Intuitively, if your chance of beating the market is greater, you should put more into single stocks. Similarly, if you beat the market more in your winning trades than you lose in your losing trades, it would make sense to put more into single stocks. Personally, I estimate that my chance of beating the market is low, probably around 10%, so I put 10% into my single stock portfolio. If you want to learn more about this and the equation that governs it, then just look up the Kelly criterion. As you can see, combining ETFs with single stocks creates greater flexibility and certainly the potential to outperform. If you found this video helpful, please do like it, and don't forget to subscribe to Trading 212's channel so you don't miss any videos in future.